Welcome to the e-learning module of Financial Planning and Analysis Overview. Let's begin the learning. Financial planning is like navigation. If you know where you are and where you want to go, navigation isn't such a great problem. It's when you don't know the 2 points that it's difficult. As you might already know, if you want to learn accounting, you learn it one concept at a time, one principle at a time. It is the process of estimating the capital required and determining its competition. It is the process of framing financial policies in relation to procurement, investment and administration of funds of an enterprise. It helps in ensuring a reasonable balance between outflow and inflow of funds so that stability is maintained. It ensures that the suppliers of funds are easily investing in companies which exercise financial planning. A financial planning and analysis (FP&A) system helps managers assess the company's future and know if they are reaching their performance goals. A complete FP&A system includes subsystems for 1. Planning, 2. Measuring and recording results, and 3. Evaluating performance. The planning component of the FP&A system is called the master budget. It is intended to help ensure that plans are consistent and yield a result that makes sense for the organization. A budget is a detailed plan, expressed in quantitative terms, that specifies how resources will be acquired and used during a specified period of time. The procedures used to develop a budget constitute a budgeting system. Budgeting systems have 5 primary purposes: 1. Planning, 2. Facilitating communication and coordination, 3. Allocating resources, 4. Controlling profit and operations, and 5. Evaluating performance and providing incentives. Let's understand budgeting and forecasting. Capital budgeting. Capital budgeting, and investment appraisal, is the planning process used to determine whether an organization's long-term investments such as new machinery, replacement of machinery, new plants, new products, and research development projects are worth the funding of cash through the firm's capitalization structure. Types of budget. Static budget. Budget for a single activity level, usually the master budget. Flexible budget. Budget that indicates revenues, costs, and profits for different levels of activity. Sample master budget. Different types of budgets serve different purposes. A master budget, or profit plan, is a comprehensive set of detailed budgets covering all phases of an organization's operations for a specified period of time. Scope of budgets. Budgeted financial statements, often called pro forma financial statements, show how the organization's financial statements will appear at a specified time if operations proceed according to plan. Budgeted financial statements include a budgeted income statement, a budgeted balance sheet, and a budgeted statement of cash flows. A capital budget is a plan for the acquisition of capital assets, such as buildings and equipment. A financial budget is a plan that shows how the organization will acquire its financial resources, such as through the issuance of stock or incurrence of debt. Budgets are developed for specific time periods. Short-range budgets cover a year, a quarter, or a month, whereas long-range budgets cover periods longer than a year. Rolling budgets are continually updated by periodically adding a new incremental time period, such as a quarter, and dropping the period just completed. Rolling budgets are also called revolving budgets or continuous budgets. The master budget comprises many separate budgets, or schedules, that are interdependent. In small organizations, the procedures used to gather information and construct a master budget are usually informal. In contrast, larger organizations use a formal process to collect data and prepare the master budget. Such organizations usually designate a budget director or chief budget officer, which is often the controller. Firms with international operations face a variety of additional challenges in preparing their budgets. First, a multinational firm's budget must reflect the translation of foreign currencies into US dollars. Since almost all the world's currencies fluctuate in their values relative to the dollar, this makes budgeting for those translations difficult. Although multinationals have sophisticated financial ways of hedging against such currency fluctuations, the budgeting task is still more challenging. Second, it is difficult to prepare budgets when inflation is high or unpredictable. While the United States has experienced periods of high inflation, some foreign countries have experienced hyperinflation, sometimes with annual inflation rates well over 100%. Predicting such high inflation rates is difficult and further complicates a multinational's budgeting process. Finally, the economies of all countries fluctuate in terms of consumer demand, availability of skilled labor, laws affecting commerce, and so forth. Companies with offshore operations face the task of anticipating such changing conditions in their budgeting processes. When a supervisor provides a departmental cost projection for budgetary purposes, there is an incentive to overestimate costs. When the actual cost incurred in the department proves to be less than the inflated cost projection, the supervisor appears to have managed in a cost-effective way. At least that is the perception of many managers, and, in the behavioral area, perceptions are what count most. These illustrations are examples of padding the budget. Budget padding means underestimating revenue or overestimating costs. The difference between the revenue or cost projection that a person provides and a realistic estimate of the revenue or cost is called budgetary slack. Top-down and bottom-up approach in budgeting. Most people will perform better and make greater attempts to achieve a goal if they have been consulted in setting the goal. The idea of participative budgeting is to involve employees throughout an organization in the budgetary process. Such participation can give employees the feeling that this is our budget, rather than the all-too-common feeling that this is the budget you imposed on us. While participative budgeting can be very effective, it also can have shortcomings. Too much participation and discussion can lead to uncertainty and delay. Also, when those involved in the budgeting process disagree in significant and irreconcilable ways, the process of participation can accentuate those differences. Finally, the problem of budget padding can be severe unless incentives for accurate projections are provided. Forecasting. Why forecasting is important. Forecasts serve as a basis for planning. Enable healthcare managers to anticipate the future to plan the system and plan the use of that system. Forecasting is more than predicting demand. It is not an exact science. One must blend experience, judgment, and technical expertise. Common elements in every forecast. Assumption that past continues into future. Errors occur. Actual differs from predicted. Presence of randomness. Forecasts of group of items, aggregate, tends to be more accurate than individual items, i.e., departmental versus whole hospital. Forecast accuracy decreases as time horizon increases. Characteristics of a good forecast. Timely. Reliable. Accurate. Meaningful units, dollars, visits, discharges, patient days, etc. Easy to use. Steps in the forecasting process. Step 1. Identify the goal of the forecast. Step 2. Establish a time horizon. Step 3. Select a forecasting technique. Step 4. Conduct the forecast, analyze data. Step 5. Determine its accuracy. Step 6. Monitor the forecast. What makes a forecast a good one? Timeliness. Accuracy. Meaningful units, dollars, visits, etc. In writing. Simple to understand and use. Relationship between budget and financial forecasting. A budget is an outline of the direction management wants to take the company. A financial forecast is a report illustrating whether the company is reaching its budget goals and where the company is heading in the future. Budgeting can sometimes contain goals that may not be attainable due to changing market conditions. If a company uses budgeting to make decisions, the budget should be flexible and updated more frequently than one fiscal year so there is a relationship to the prevailing market. Budgeting and financial forecasting should work in tandem with each other. For example, both short-term and long-term financial forecasts could be used to help create and update a company's budget. Variance analysis. Actuals versus budget. Forecast versus budget. Budget versus forecast. You have successfully completed this module on financial planning and analysis overview.